Creamer Media's Mining Weekly is speaking to Paul Miller, the director of AmaranthCX. And we're going to talk on the current lack of appetite for particularly junior mining stocks on the Johannesburg Stock Exchange and what should be done to restore that appetite. Paul, how has the South African savings and investment industry been changed by the Financial Advisory and Intermediary Services Act, the FICE Act?
Well, Martin, it's a story that goes all the way back to the early 90s when a series of reports were released. They were called, I think, the Jacobs Committee reports, and they investigated what needed to change in the way that savings were managed in South Africa. And I believe that was the genesis of a whole series of reforms that have played out over the last 30 years. One of the most significant of which was, of course, the FASE Act as we know it, right? But it wasn't the only one. The context is also the changes to the Financial Markets Act, which has allowed new stock exchanges to be created, the relaxation of exchange controls, the different tax incentives that are provided. There have been a whole series of changes over the last 30 years. And I think, in general, they've been very good, particularly for savers, for ordinary savers. But there have definitely been some unintended consequences. And I think you can see the unintended consequence in the year-on-year decrease in the number of listings on the JSE. For example, we see as the market cap, the overall market cap of the JSE has gone up, the number of listed companies on the JSE has gone down. And that's happened because smaller companies have been bailing out. They've been leaving the stock exchange. And of course, it's smaller companies raising primary capital on the JSE, which is the exciting stuff for engineers, for example, because that means they're raising money to build things or to dig new mines, and really at the entrepreneurial heart of the economy. What we've seen instead is ordinary savers are treated better by what used to be a quite predatory financial services industry, and that's a good thing. They've got cheaper products, they've got a wide range of products, and advisors are required to provide them with a fiduciary duty, in other words, look after their interests first. Mis-selling has been cut back, dodgy brokers have been forced out of the industry. It's generally been good, but it seems to have benefited savers, and it's benefited other countries like to call the big end of town. So we've seen a lot of benefits flow to large institutions, the top 80 listed companies, the listers of products on the stock exchange. And we've seen very little benefit flow to smaller companies.
And so why has this negatively affected retail investor numbers and liquidity in smaller stocks in general and junior mining stocks in particular?
It's a good question, because I think that was the unintended consequence, because retail investors have benefited from the reforms in the sense that they're no longer having product pushed on them, they're not paying unreasonable commissions, they're not being misadvised, they've got all sorts of non-legal routes to follow to get relief if they've been mistreated by the financial services industry. So there's been a lot of benefit to the ordinary saver. Where there hasn't been benefit is that those savers are now all saving via large institutional funds. And those intermediaries in the middle, the large institutional funds, are only interested in the big end of town on the stock exchange. So we've taken the retail money that was being mistreated by those large institutions and their brokers. We've taken them, and they are now treated much better by the financial services industry and the brokers and the financial advisors, and that's a good thing. But what it has is it's taken them out of direct investment into the stock exchange and put them in indirect investment through large funds. And those large funds, for a whole lot of reasons, tend to concentrate only on the top 80 listed stocks and the liquid exchange-traded notes, exchange-traded funds, retail, real estate investment trusts, what I call the big end of the stock exchange. And the unintended consequence of that is that there aren't small investors for small companies as there were in the past. And the most significant change is that the nature of stockbroking has changed, because stockbrokers themselves have converted themselves into wealth managers. So they are now also taking retail investors' money and putting them into large institutional funds that only invest in the big end of the stock exchange. So that's the change that has negatively affected smaller companies on the stock exchange. And if we look at the numbers, it's very significant. We went from about 700 listed companies at the time of the first Jacobs Committee report. And the Jacobs Committee predicted that the flow of funds into institutional savings would lead to an increase in the number of listed companies and an increase in the primary capital raising on the JSE. At the time, the only stock exchange was the JSE. That didn't happen. What actually happened is we saw an increase in funds into the institutional savings industry, but all that money is gathered at the big end of the stock exchange because of their liquidity and size requirements. It hasn't flown through to primary capital raising and listings of new companies. Now, of course, we can't ignore the context, right? If you've got a state that is sucking the entrepreneurial energy out of the economy, then of course, that's another reason why you're not going to get primary capital raising and smaller companies listing on the stock exchange. So of course, that's happening too.
So Paul, what should be done to fix all this and get us back to having an appetite for smaller stocks and being able to put some of our money into smaller stocks?
Well, I think we have to acknowledge there's been an unintended consequence. And for too long, the debate has been companies aren't listing because the JSE is doing something wrong, like the JSE's rules or bureaucracy or costs. In actual fact, the JSE's requirements are not very different to stock exchanges around the world that have had a lot of success in attracting smaller companies. So I think we need to move the discussion away from saying it's the JSE's fault. It's their listings requirements that are at fault. I don't believe that's the case. There are always things that can be tweaked and improved, etc. But that's not fundamentally the problem. The fundamental problem here is that all our savings, and we've got significant contractual savings in the South African economy, flows to large institutions that place them at the big end of the stock exchange. Now, so the question, it strikes me, on one side you have savers, on the other side you have companies that need capital, and in the middle you have the so-called self-declared capital allocators through the financial services industry. And the benefits that have flowed to investors through the tax incentives they've got for pension fund savings, tax-free savings accounts, all the benefits, the fact that collective investment schemes get beneficial treatment on capital gains relative to other forms of stock investment in shares, all those benefits flow to investors. That's good. But they also flow to the institutional savers, and they do not flow to smaller companies. And I think we need to rebalance that equation. Smaller companies need some sort of incentive to list on the stock exchange. We've taken all our savings and pumped them into the big end of town to the detriment of the small end of town. And it's time now to rebalance that equation. And funnily enough, the ANC even recognizes that in their economic policy document that they published last year, as it relates to junior mining companies.
That was Creamer Media's Mining Weekly, speaking to Paul Miller, the director of AmaranthCX.